Hi, if you follow the news, you must have come across a lot of news items in the recent times saying how many banks in the Western countries, developed economies, are at the risk of failure. Some banks have failed also. So, in this video, what we're going to do is we're going to understand why this is happening and how this can impact India, right? So, why Western banks are suddenly looking a little shaky and how this can impact our country. So, let us first understand what is going on with these Western banks, right? So, first, what happened was that there was this bank called the Silicon Valley Bank. It was the 16th largest bank in America, and this bank failed in early March 2023. On 10th March, it failed as a result of a bank run. A bank run is basically an event when all the depositors or a large section of the depositors of a bank rushes to the bank together to withdraw their money, right? And the way the banking system works, banks never have money to give away to all the depositors. So they keep some part of the money in reserve, and rest of the money they give out as loans. So that is how banks earn money, right? And if all depositors want money at the same time, then banks will not be able to pay that back, and as a result, the bank will fail, which is what happened with the Silicon Valley Bank, right? So, and after Silicon Valley Bank collapse, a lot more middle-sized American banks have come under risk, right? So there is this bank called the Signature Bank, and there is another bank called the First Republic, which are again like looking very weak right now. And these banks have either had to draw upon support from the U.S. Central Bank, which is the U.S. Federal Reserve, or some larger banks have come together to put money to restore the confidence of the public that no, these banks are going to be safe, right? So this is what is happening with the American banks. And then what has happened in Switzerland, there was this bank called Credit Suisse, which was one of the oldest banks in the world, right? It was almost 170 years old, and it was one of the most important banks in the world as well. It was one of the 30 systematically important banks across the world, right? So that bank has failed. So what has happened? Credit Suisse was on the verge of failing. So Swiss government involved, and it pressurized the second largest bank in Switzerland called UBS. That is its name. There is no full form. It pressurized UBS into taking over this bank called Credit Suisse. So overall, this is what has been happening, right? And as we are recording, more and more like banks are looking at risk, but we'll see why possibly this thing might be contained through regulatory action, right? So why are these banks failing? So we'll talk about the American banks as a category, what is happening in America, and we'll understand what happened with Credit Suisse in like particular, right? So let us just see this chart. Basically, this is a chart of uh, um, index or inflation excluding food and energy prices. So this is called core inflation, right? So core inflation chart for like 1 second, let me, yeah. So look at this period. So this is starting at somewhere around September 2018 and up to January 2023. This chart shows how the inflation rate, the core consumer price inflation has changed in the US. So you can see like inflation was pretty like moderate, right? The US expectation is that we keep it around 2%. So it was between 2 and 3%, and then it fell. And then this whole period we know COVID pandemic was going on. So the central banks in the Western countries created a lot of money. Government gave a huge fiscal stimulus to the economy. People were given money, and inflation went up very sharply. So these levels of inflation that you see around 7%, 8%, these inflation levels are as high as they were around some 40-50 years ago. So the Western countries had last seen such high inflation in the 1970s, right? So their expectation is that inflation will be somewhere around here, somewhere around 2%. But as a result of the fiscal and monetary policies during the COVID pandemic and also economic issues, inflation has gone up very high. So just to like give you an idea in brief, what has happened is basically during COVID, businesses were shut down, right? So governments gave a lot of support to people in form of money transfer. So the central bank created a lot of money and also reduced the interest rate. We'll see that in a minute. So that money supply became very cheap and liquidity in the system increased. So people had a lot of money in their hands. At the same time, the economy was virtually shut down. So supply chains were not working. Train, traffic, workers who go to, let's say, warehouses or like meat processing plants in the US and all. So these places were struggling for workers also. So basically, people had a lot of money in their hands, but the supply of items that they wanted to buy was limited. As a result, prices increased because there was a lot of money chasing very few goods, right? So as a result, prices increased. This is what you see in this inflation chart, right? So initially, the Western banks thought, or the central banks, to be more precise, they thought that inflation is what they call transitory, that over time this will correct on its own. We don't need to take any action, right? So what happened as a result was that the interest rates, right, were kept at almost zero, right? This is the US. A lot of European banks also like implemented similar policies. So interest rates in the US and Western economies were very low for a very long time. Then somewhere you can see around middle of 2022, right? This is July 2022. So the US Federal Reserve said that no, this inflation is not going away on its own and we need to take action. So then it started following what is called a tight monetary policy. So what happens in case of tight monetary policy is that the central bank tries to increase the cost of money and reduce the supply of money in the system. So we discussed how there was a lot of money in the system and there were not enough goods, right? That's why prices were increasing. So if you increase the cost of money, which is the interest rates, and you reduce the supply of money, then you reduce how much money is there in the market. So what happens is you try to drive down consumption, right? And consumption is the largest driver of economic growth or inflation in this case, right? And then you make money more expensive. You try and reduce economic growth, right? So people have less money, they want to spend less. So the US Federal Reserve has, this is the way in which they have increased their interest rates, right? So in a very short time, interest rates have been increased to quite high levels. So in 2018, you can see interest rates were around 2%. And then like in 2020 onwards, they have cut rates very sharply. And for 2020, like you can see, this is for July 2020 till almost like early 2022, middle of 2022, actually, interest rates in the US were almost close to zero. So like cost of borrowing was very low, so people could take loan, they could buy cars, they could buy houses, businesses could take loan and they invest in creating new businesses and all, industries and all. But now suddenly, as you can see, this in a very short time, they have increased rates to almost 5%, right? So they have increased rate almost to 5% from 0%. There's a huge increase in interest rate, right? So as a result, what has happened is that they're trying to bring down the demand. So this is what has happened in the economy. Now how is this interest rate related to the failure of banks? So let us now see what happens. So basically, when banks get money from depositors, they are required to keep some amount as reserves, like we discussed, and rest of the money they can give out as loans. Now this money that the banks keep as reserve, or like let's say bank is getting 100 rupees in deposits, right? It is able to give out 50 rupees as loans. So out of 50, some are required reserves, let's say 10%. So 10 rupees it is required to keep as reserves at all time, but still it has got this 40 rupees. Now it needs to earn a return. That's how it is going to pay the depositors and interest and meet its cost and make profits, right? So banks also make investments. So one of the most popular instruments where banks invest their money are these government bonds, right? And particularly very long maturity government bonds, which are going to mature in, let's say, 10 years, 20 years and so on, right? So what happens is banks invest large amount of money in these government bonds, right? Now we have seen that the central bank of the US and many Western countries, also in India, they have increased interest rates very sharply because inflation became very high, right? So now what happens is that these bonds, their prices fall when the interest rates increase, right? What happens is, if I am buying a bond, right, then I am buying at a particular interest rate. Now the price of these bonds and the interest rates move in opposite direction. So if the interest rates increase, the price of bond decreases, and this effect is more on the longer maturity. And these are the kind of bonds, remember we discussed that the banks buy more, right? So banks buy more of these longer maturity bonds, which are quite sensitive to changes in interest rates. And nobody thought that interest rates would increase so rapidly, right? So now interest rates have increased rapidly. As a result, what has happened is the prices of these bonds have moved in the opposite direction at the same speed. So as interest rates have increased rapidly, the prices of these bonds have fallen equally rapidly, right? So what has happened now, if you bought a bond at 100 rupees, let's say, right, now its price has become suddenly, let's say, 60 rupees. So you are sitting on a loss of 40 rupees, right? You might not have sold it, but you are still sitting on a loss of 40 rupees. Now if you are a depositor in a bank, right, you fear, oh, bank is making so much losses, will it be able to pay me back my money if I need it when I need it? So in case of money, what happens? You will first act and then think, right? You will say, I don't know what is going to happen. Let me first withdraw my money, right? And then I'll see whether our bank survives or not. I don't want to take that chance, right? That is the rational response. And in cases of banks such as Silicon Valley Bank, what happened was that bank was quite popular with the startup companies in the US. So it had got huge deposits in the pandemic period, during which time these companies raised money quite a bit, and their valuations also increased because everyone thought that internet businesses are now going to do very well for a very long time. So Silicon Valley Bank had got huge deposits, and it had therefore invested a lot of money in these government bonds, right? And as a result of sharp increase in interest rates, what had happened, it was sitting on huge losses, right? And all these startups, they're quite connected, so all of them started acting together. And now these are not small deposits, they are not like $1,000 $2,000 deposits, they are putting money in the tune of millions of dollars. Now all these large depositors started rushing to the bank together, that I want to withdraw my money, right? And as we discussed, that banks don't have so much money lying spare, right? They have invested this money, right, and rest they have given out as loans. So if all of these large depositors together go and start withdrawing, the bank will not be able to basically pay back them all at the same time, right? So that created a bank run on Silicon Valley Bank. And as the news of a bank runs or the bank's weakness spreads, more and more people rush, right? As more and more people come to know, more and more people go and try and withdraw their money. So ultimately what has happened, that the bank collapses, because bank doesn't have money to give back, right? Bank has given a loan for, let's say, 20 years. Now if somebody has taken a loan from the bank for 20 years to buy a house, bank says, oh, I want my money back. That person says, I don't have the money, right? I have invested that money in a house, I am paying you the EMI or the monthly installment, I can't pay you back the whole amount, right? And typically then, and even if they try to sell the bonds, they will have to absorb huge losses, because maybe the bond that we bought at 100 rupees is now at 60 rupees, so 40 rupees loss you will take. So all of these factors combined leading to the collapse of Silicon Valley Bank. And similar issues are there in the other smaller or middle-sized American banks as well. Because what has happened is, when the world faced a big financial crisis in 2008, the American Parliament, or the US Congress as it is called, had passed a law called the Dodd-Frank Act, under which the banks were then required to undergo more strict regulatory oversight, so that they don't take inadequate or they don't take too much risks, right? But during the presidency of Mr. Donald Trump in 2018, some banks like Silicon Valley, so some mid-sized banks basically were removed from the strict provisions of oversight, right? So the Federal Reserve was not stress testing these banks as it was doing the larger banks. So if you see the news also, the problem right now in the US is not with the larger banks, because they are regularly stress tested, as if like if some events happen such as rapid rise in interest, then how they will be able to cope with it. Moreover, Silicon Valley Bank was also not managing its risks properly. They never imagined that interest rates will rise as much, but at the same time they never like took actions to guard against some unforeseen circumstances. For a very long time, almost a year or so, they didn't even have a chief risk officer. When they failed, they didn't have, right? So they were not really concerned about risk. They thought nothing will happen, and as a result they have failed. And the same story is there across all these smaller banks in the US as well, right? So this is the part about interest rates and government bond, how that is leading to bank failure, right? Now basically, so that is a summary of what we have said, right? They have invested in US government bonds, which are considered the safest assets, but they are very sensitive to rise in interest rates, right? So bond prices, as we discussed, fall when interest rates increase. And these banks have not planned for a scenario, because as we saw, for a very long time interest rates have been very low in US and almost all Western countries. Very close to zero interest rates have been, and suddenly from that they have reached almost five and a little over five also now, right? So now, coming to Credit Suisse. Credit Suisse is a different case. So the American banks so far that have failed have been because of poor risk management. They have invested in safe assets, right? The US government bond, if that bond is going to mature in 20 years, if you hold on to it for 20 years, then you will be able to get your money back. But right now, if the depositors fear and there is a panic run, then you will not be able to give them back their money, right? So that's the mismanagement of interest rates, right? Risk. And what has happened in the case of Credit Suisse is basically poor business practices, right? This bank has been under pressure for a while. It lost almost $8 billion in 2022, out of which almost $5 billion was on a single company. It had invested in a hedge fund where that fund collapsed, and the bank lost a lot of money in that. Before that, there have been a lot of scandals. It was spying on staff of UBS. So the president or the chairman at that time had to resign. A whole new leadership was brought in. But basically, Credit Suisse has been a problem area for a while, and its share prices, even before this collapse, so its share prices has fallen by more than 70% from the high levels that they had reached in 2021, right? So even before this collapse, this bank was undergoing problems, right? So like we saw, it had investment banking arm, so it made investments. So there they had lost, like I said, almost $5 billion in one transaction itself. And it had very wealthy people as clients. So all those people have been withdrawing money from this bank for a while now, right? So this bank was not like they have invested in safe assets, but because of like this interest rate, they have failed. They were like doing dodgy stuff, right? So but why has it collapsed now? So what had happened is, there is the Saudi National Bank which had invested in this Credit Suisse, right? So Saudi National Bank had acquired 9.9% share in Credit Suisse for $1.5 billion in November 2022, right? And recently, when all these banks started collapsing and there was like a sort of concern about Credit Suisse also, the Saudi National Bank leadership clearly said, no, we are not going to put in any more money in Credit Suisse. One of the reasons was that once some shareholder acquires more than 10%, they are subject to more stringent regulatory oversight and all. So the Saudi National Bank people did not want that. But Credit Suisse was struggling for funds, right? So as soon as this news became public, then the pressure on Credit Suisse intensified again. The share price started falling like crazy, and people started like withdrawing money at even faster rate. And then Credit Suisse basically looked like it is going to collapse. Right now, what happened is that the Swiss government basically got involved, and it basically, like we will see, forced the second largest bank in the Switzerland to acquire Credit Suisse, right? So remember this price, right? They have paid almost $1.5 billion for 10% share in Credit Suisse in November 2022. Now we'll see how the value has changed just in a bit. So now will come, what are regulators doing to address what is happening with banks, right? So first, basically now the focus of regulators is to assure the people that please don't go and try and withdraw your money at the same time. Your deposits are safe, right? So in the US, what has happened when Silicon Valley Bank failed, there is a deposit insurance scheme, right? FDIC is an entity, the Federal Deposit Insurance Corporation, basically that insures the deposits in US banks up to $250,000. So every person's deposit in a US bank is insured up to $250,000. So if that bank fails, at least that much money they will get. But now, in case of Silicon Valley Bank, the US regulators basically, they declared that Silicon Valley Bank was a systemically important bank. It was important to the economy of the US. And using that provision, they basically said, we will give all depositors all their money, right? Because like, remember we discussed in the case of Silicon Valley, their main customers were these startup companies who deposited millions of dollars in their bank accounts, right? So to make sure or to reassure the depositors that your money in the banking system is safe, they said, we will make sure that all your money is returned to you. This is important because remember, like we have earlier discussed, banks are based on confidence, right? If I go and deposit money in the bank does not have the money at all times. It has given loans, it has invested and all, right? It can give me only some part of my money at some time, or individually, right? If all the depositors go, then it will of course not be. If I want to, as an individual, I want to go, obviously it will have enough money. But overall, if there are 100 depositors, all of them want their money back at the same time, then the bank will not be able to give. So that's why it is important for the system to have confidence of the depositors. Depositors should have confidence that whenever I go, I'll be able to get my money back. So then nobody, all the people are not going to like ask for all their money at the same time, right? So that is the basic principle on that, on which banking works. That the basic belief in the banking system that it is going to survive, right? So now by doing this, they are basically trying to reassure the people, right? And now there is a proposal that you say that all the money in the banks in the US is safe, right? About 250,000 million, billion dollar, whatever you have no fear, right? We are going to insure all the deposits. So the idea behind it is, even if you insure all the deposits, it's not like everybody is then going to rush. It is basically you are reassuring, you are telling the people that don't panic. Even if the bank fails, I am here, the government will give you back all your money. So then if that confidence is there, then people are less likely to go and do a bank run. And if there is no bank run, then the banks don't have any reason to fear. They will be able to meet normal business demands of money and all, right? So that is the basic idea behind this proposal. So far it has not happened, but the US regulators have, the US finance minister, or the treasury secretary as it is called there, she has said that all the money is safe. The US Fed chairman, Mr. Powell, he has said there is no need to panic, the US banking system is safe, right? So they are trying to reassure depositors that banks are safe in the US, right? Simultaneously, like we were talking about Switzerland or Credit Suisse, which is a separate case, but it was very large bank, so its failure would have had a lot of created a lot of problems for the global economy. So the Swiss government, basically, like I said, it got into the issue, and it basically told UBS that you have to buy Credit Suisse, right? So Credit Suisse basically was sold to UBS for around $3.2 billion. All of Credit Suisse was sold for $3.2 billion in March 2023. Just a few months ago, in November 2022, Saudi National Bank had paid $1.5 billion for 10%, right? And now all of Credit Suisse has gone for 3.2 billion. So you can imagine how much its value has fallen. Plus, the Swiss government has also told UBS that up to $9 billion of losses in certain categories we will guarantee. Because there was no time to go and examine the accounts of Credit Suisse in detail, the Swiss bank said you first acquire it, you calm down the global market, and if there is any loss that you have to bear up to 9 billion in specific types of deposits, we will like make good those losses, right? So 3.2 billion is the value of the company overall, plus 5 billion in loss they are going to absorb, right? And last reported total valuation of this company was 45 billion. So less than, like, it has become what, less than 1/5, right? If 3.2 plus 5 you add 8, right? So it's less than a fifth, right? So that is how much money has been lost. Simultaneously, what has happened is, because all central banks like want to ensure in all countries that the system is stable and there is no panic in the people and the businesses, they have come together. So many of these regulators, like the US Federal Reserve, Bank of Canada, Bank of England, Bank of Japan, and the US Central Bank, plus the Swiss National Bank, all these central banks came together. They said, don't panic. Globally also there is no problem. We are like working together to make sure that if you need money, if the banks need money, internationally also money will be available. So don't panic. If emergency withdrawals increase, banks will be supported by the central banks of these countries. So regulators are trying their best to basically calm down the public also, and also make sure that in case of emergency need of cash, banks also have the cash required, right? So that is what the regulators are doing. Now let us come to our country, right? How is this crisis going to impact India if it spreads? Despite best efforts, if banks continue to fail, if more poor investments come to light, how will this impact India, right? So as of now, Indian banks are like not at risk, right? Indian banks have been under stringent RBI regulations since the time Mr. Raghuram Rajan was the RBI governor, and then Mr. Urjit Patel, and now Mr. Das. All these governors have focused on improving the accounting practices and oversight of banks. As a result, a lot of like bad loans are now have been identified, and the balance sheets of the Indian banks have been cleaned to quite an extent. So hopefully, from what we know as of now, there isn't a lot to worry about the Indian banking system, right? So that is the biggest thing to like be reassured by. But what happens is, like I said, that the banking system runs on trust, right? So now if the financial crisis or the panic is not contained in the Western markets, then some impact would be felt in India also, right? Because first of all, a lot of Indian companies would have money in foreign accounts also because of business. A lot of Indian startups get money in their foreign accounts from investors. Indian companies do business, so they get money. So they would be caught in that. Some panic would spread in India also. Foreign people who have put money in India, if they have suffered lot of losses in their countries, they might withdraw money in large amount from India to like compensate for those losses, and that then would create problems for the Indian financial system, right? And then what would happen is that in times of panic, always money moves to safer assets, right? Or this is called a flight to safety, right? So what happens is emerging markets like India are considered to be more risky, which is quite paradoxical because the risk is coming from Western markets right now, but still that is how the world works, right? So the emerging markets like India are considered to be more risky. So what will happen is money will be withdrawn from the risky assets and move to safe assets. So what are safe assets? So US government bonds, which have fallen in price quite a bit, right? But yeah. So gold, or just other government bonds. So what will happen is money will be withdrawn by investors who have put money in Indian government bonds, maybe Indian shares. So they will start withdrawing money in large quantity and moving money back to their country, right? So then what would happen is, again, because we need capital as a developing country, so all this capital going out will impact our economy adversely. Then there are a lot of startups that are coming up in India, right? So past few years have seen a startup boom, and most of these startups are raising capital from foreign investors. If foreign investors suddenly become very risk averse and they make huge losses because of financial crisis, then funding for Indian startups could become a problem. Moreover, like I said, a lot of this money is kept in foreign bank, so from there also they might become like have to make some losses, right? Then rupee will come under pressure. Now we have been discussing that there will be a flight to safety. Capital will be withdrawn from India towards other countries. Now, when money is invested in India, it is invested in the form of rupee, right? Foreign investors bring in dollar, euro, yen, whatever. They convert it into rupees and they invest in Indian assets. Now, when the reverse happens, rupee will be converted into currencies like the US dollar, yen, euro, whatever, right? So what happens? Like, just remember the example of inflation, that there was too much money and there were too few goods. That's why the value of money decreased, which we say inflation, right? Now, if there is too much rupee, there are too many rupees suddenly in the market, and demand for dollar increases. What will happen? The price of dollar will increase relative to the rupee, meaning you will have to pay more rupees for each dollar, right? So that is called the exchange rate. So the rupee we call will depreciate. So rupee will depreciate. That is what is written here, that the rupee will come under pressure. Basically, right now you pay around 81 rupees for $1. Maybe suddenly it will go down to 85 or something, right? So you will have to pay more rupees for each dollar. Now we import a lot of items. We are a net importer. So when we import, we have to pay in foreign currencies like US dollar, euro, etc. Now, because the rupee is depreciating, these foreign currencies will become more expensive, right? So now if something costs $100 earlier and still costs $100, right, before the depreciation of the rupee. So let us say before the depreciation, the exchange rate was 80 rupees equal to $1, right? So for $100, you need 8,000 rupees. Now suddenly, because of this flight of capital, rupee depreciates and the value of rupee now is 85 rupees for $1, right? And the whatever you are importing, it still costs $100. So suddenly from 8,000, you have to pay 8,500 rupees, right? Correct? Because the value of rupee has decreased by 5 rupees to a dollar, you need $100. So your cost has increased by 500 rupees. Right? In dollar terms, the cost has not changed, right? But you still need to pay more, right? So imports will become more expensive, right? At the same time, exports will become more competitive. So depreciation of the currency will be more like beneficial for the exporters, because why? Again, they will sell in dollars. So if somebody was selling something for $100 earlier, they were getting 8,000 rupees. But now if they are selling the same thing for same $100, they will get more money, 8,500, right? But generally it doesn't happen. What happens is their foreign buyers will say, oh, rupee has depreciated, now you need to reduce the dollar price. So it's not a fair world, right? So that's how it generally works. But what will happen is exports will suffer because the demand in those markets will go down, right? So if the US is going through a financial crisis, people will not want to buy the same amount of items from exporters. And if you're a business, for example, let's say a TCS or Infosys, a lot of your clients are these financial companies, right? Now, all these financial companies, if they collapse, your customers have suddenly disappeared, or there are mergers. So then they will try and have the same, like same system throughout, right? So then, like again, the demand for your products and services would be reduced. And the IT industry in India is a very large employment generator, also a very, very important source of foreign exchange for the country. But if the financial situation in the Western markets deteriorates quite badly, this industry will be the worst impacted, right? And then commodity prices might cool off. Cool off meaning their prices might reduce because demand falls, right? So things like oil, etc., which again we import almost 85% of our oil. So if you follow oil prices also, what has happened is oil prices have gone down, because if the Western economies enter recession, what will happen is economic activity in those places would reduce. There will be less demand for these items, so their prices will fall, right? So that will benefit us. But we don't want to be in such a situation, because one small benefit and overall largely will end up losing quite a bit, right? So, and then domestic inflation could increase, right? Why this will happen? So inflation in India could increase if the Western central banks prioritize financial stability over price stability. So what does price stability mean? Price stability means maintaining a moderate rate of inflation, right, at around 2%, which is the target of the Western banks. And financial stability means keep preserving the financial system, right? So we saw how they have been increasing the rates quite steeply in an attempt to bring down the inflation rate, right? But now inflation has not come down yet to their target, right? It is still at around 7 odd percent, and they want to bring it down to 2%. But now the threat is of their all their banks collapsing. If they keep increasing the interest rates, what will happen? The bond prices will continue falling, right? And these banks are already sitting on huge losses. So what do they do? They're in a very bad situation. They have to control inflation. They have to save their system as well. So what will they do? Like that will impact our country also, right? So what will one possibility is, if like the main point says, that if they prioritize financial stability, then they will stop raising rates. They might even start cutting the rates, right? Because then the prices will of the bonds will increase, right? So the banks will feel a little safer. So now if they stop raising the interest rates, so that bond prices don't fall and bank failure risk is controlled, what will happen then? That inflation will stay high, right? Inflation, they will then say ki, okay, we will have to live with higher inflation for some time till we figure out a way to like control this banking system crisis. Now India will then import this high inflation. What does that mean? India imports a lot of items from the Western countries, things like capital goods or high tech equipment, software, high consulting services and all, right? So a lot of things we import. So now if inflation is high, the prices of those items in those countries is high. Now we have to pay the high prices. So we will get those things at a high price. Now if we are getting, let's say, a very, very advanced piece of machine for a very high price, whichever business is importing, or a computer, right? So now the business has to make money, so its costs are going up, so it will be forced to raise the prices of its product or service in India, right? So as a result, because the Western countries are not able to contain inflation in their countries, we will have to basically import that inflation into our country, and for no fault of ours, we will have to go through this period of high inflation as well. So basically, what I'm saying is, uh, no country is an island when it comes to economic matters. Now, don't start looking at your map at countries like Australia and Sri Lanka. Remember what I said? No country is an island which, when it comes to economic matters, right? So there is a flow of finances across the world, right? And if you want to be benefit from like that flow, you expose yourself to these kinds of risk as well. So unfortunately, India has been quite prudent in its management of the economic policies over the past few years, but still, because of negligence or poor management practices, or like regulatory failure also in some cases in the Western countries, we might have to like suffer through these consequences, right? So inflation will stay high in our country as well. So that basically captures. Now this is still an evolving situation, but I hope now you understand why banks are failing or at risk and how our economy will be impacted, right? I hope you enjoyed this video. I hope you learned something, and we'll keep making more and more such videos, and you keep watching. I'll see you soon in the next video. Till then, take care and bye.